My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'm doing, my friends, I'm just trying to make you a little money. My job, not just entertain, but to educate and explain how days like today can happen. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Listen to me. A year ago today, the NASDAQ peaked. The world we thought we knew came to an end, and the highest of growth stocks began their slow motion crash and burn. Look, even on a good day like today, and it was a good one, with the Dow gaining 298 points, the S&P advanced 1.36%, the NASDAQ climbed 1.36%. Doesn't come close to erasing the trillions in lost wealth that we've seen. So we can't let one strong day throw us off the real narrative of the last year, which is big losses for your portfolio. Sell. Much of these losses are concentrated in businesses that are hidden to you and sound very confusing, not exactly like each other. Enterprise technology, software companies that help other businesses do things more efficiently or that help you digitize whatever hasn't already been digitized. Now, here I'm talking about tech that was meant to remove the friction in banking or real estate or car buying or anything else. Others are companies that started small in one cloud vertical and then expanded to other cloud verticals, creating newfound and, yes, indeed, ruinous competition. Meanwhile, we've got some gains, too, though only in a handful of what I call prosaic companies, the drugs, the foods, the trade-down retailers, just enough to justify saying that there is indeed always a bull market somewhere, but not very much of one. And what created this new market? The Federal Reserve, that's who. 1 year ago is when the Fed decided to take away the proverbial punch bowl, declaring war on the worst inflation in 40 years. That's the only common explanation for all these declines, because in many cases, the underlying financials really didn't change, at least not in the first 6 months. Now, we can start with big tech. Let's call it FANG plus M&T. I don't even care anymore. These used to be some of the most durable stocks out there. Even when the economy got weak, they got hit with a hurricane of wealth destruction this time around, though. For ages, nothing has been able to stop Amazon, not since they first branched beyond books. But then they expanded too aggressively during the pandemic, right before the Fed started tightening aggressively. The stock's now sunk from 179 at the close on November 22nd last year to 93 bucks because they've got huge exposure to advertising and cloud infrastructure. These are two areas nobody wants to touch in this market because advertising has softened, as it always does, as a recession bodes, and Amazon finally got real cloud competition, not just from Microsoft's Azure, but lately Google's cloud offering. Longer term, though, I think Amazon can recover after the Fed's done its job. Same goes for Microsoft, which has plunged from 340 to 245. Sell. While Microsoft's got a dandy enterprise business, including the aforementioned Azure, their gaming and PC divisions, they are what I call a nightmare.
The house of pain.
These two groups are untouchable. Just look at their chip suppliers, AMD, Intel, and NVIDIA, all down nearly 50% for the year. Staggering. Netflix had been the envy of the entertainment industry, but now it's the envy of nobody, with its stock down from 659 to 286, although it's actually better than it's been. Now, the envious one included Disney, which took a similar plunge after hitching its star to streaming. At least Netflix has been headed in the right direction for the last few months, and of all these stocks, I actually prefer it. Tesla's nosedive from 385 to 169 seems to be ongoing, now that CEO Elon Musk is in self-administered Twitter purgatory. He needs to use his Tesla shares as a piggy bank right when the company is being raided by softer Chinese sales. Alphabet's gone from 146 to 97, a stunning decline given that it was never particularly expensive to begin with. Culprit, too many people, too little advertising. I don't even know what to say about Metaverse, which has gone from 345 to 111. Advertising declines, crazy spending on an untried idea, bet the farm on something so new and different only one person, the CEO, understands it. Tough climb back, that's all I can say. Only Apple has hung in there. It's gone from 161 down to 150. Big deal, because it doesn't have too much exposure to the advertising or enterprise businesses. That's what you want. Yet Apple is consistently the most hated. It's always vilified. What's with these people? I say own it, don't trade it, and stop listening to them, whoever they are. The most compelling thing I can say about these big tech cap stocks is that I think they ultimately can come back. They're the best of the best. Even they need to get their employment tables in order, though. I'd say the same about the top 12 tier software companies, ServiceNow, Salesforce, Adobe, and Workday, all of which are down huge. Nearly all of these, save Apple, are variations on the same story. Stocks that were cut in half when their businesses had no such come-downs, but a lot more competition. Their stocks just got way ahead of themselves before the Fed took away that easy money and the market sizes shrunk, so they started going after each other's businesses. How do you tell the difference between what can come back and what can't? Well, it helps to have been through this before, back during the dot-com collapses I have. Back then, it was the best of breed that eventually managed to rebound. The rest of them just never came back. Not the stocks that were the hottest. Those were the worst performers. Now, let's go over some of them that were really hot that I think can survive but are not going to come right back. Consider the darlings of the pandemic era. PayPal, going from 189 to just under 80. DoorDash, 201.54. Airbnb, 182.95. Square, 211.62. I don't question their survivability, but I do question whether they can ever revisit their old highs. Once the Fed relents, it'd be much better to be in the big tech or the top cloud plays, or even the better chip makers. And here I'm thinking AMD and NVIDIA. That's why we hang on to so many of them for my charitable trust. Of course, the real damage comes from the lowest quality cloud names. And here we go. Let me give you a little bit of a, kind of a survivor list, maybe. Asana and Blend Labs, both down 87% for the 52-week highs. RingCentral, Domo, Twilio, all about 85%. Big Commerce, that's an actual company, down 84%. DocuSign, remember them? And CS Disco, Disco Inferno, down 83%, or Amplitude and Fastly, down 81%. At one time, these were huge, beloved stocks. Will they ever come back? Listen, that's just the 10 worst in the Wisdom Tree Cloud ETF, also known as the WCLD. But the losses are so stunning, you have to imagine it ripples from the bosses to the workers, to the shareholders, to the service providers, the lawyers, the accountants, ad firms, bankers, all of whom now see the writing on the wall. I don't expect big rebounds from any of these. And don't even get me started on fintech. Affirm's collapsed from 123 at this time last year to 12. Upstart's even worse, 205 to 18. Carvana, 285 to under 7. All very dot-com-ish. How about the winners during the dark period? The discounters are doing great. Burlington's up 32 points today. What an amazing quarter. Ross Stores, TJX, Ollie's, Dollar General, Five Below. They're all up anywhere from 40 to 74% off their lows. Packaged food place, really boring. ConAgra, Campbell's Soup, Centerville, Hormel, Treehouse Foods, Eli Lilly, Merck, up between 20 and 64%. Just like the action in big tech, these moves are not about the underlying business. They're about the Fed's rate hike cycle. Money managers love to buy that kind of stuff when the Fed's tightening. I got to go back to these losers, though, because the more you study them, the more you realize how genuinely crazy things got last year at this time. At one point, Wall Street simply didn't care if a company had any plans whatsoever to make money. We only cared about revenue growth and multiples to sales, not profits. Over the last year, we've escaped from that mentality, and the companies that pivoted to profitability have seen their stocks hold up a lot better than the growth at all cost names. What's the real takeaway from this scratch-the-surface collection of stocks? Simple. The business cycle is like a gigantic wave, one that cannot be bucked by the vast majority of stocks. The only nimble surfers are the companies that can triumph in a downturn, simply because their business is more or less recession-proof. What drives me nuts is that the analysts who follow these stocks professionally never seem to realize that all the market's a stage, and all the stocks are really players. They have their exits and their entrances, and one stock in its time plays many parts. Keeping with that Shakespearean theme, the enterprise stocks were the most loved. They sounded like their businesses were always in the first inning and the world was their oyster. Then they found out they were in the eighth inning, and suddenly it was time for them to make their exits. The money's now spent. The loss is indelible. While the great ones will come back, but who knows when? Bottom line, never let it be said the Fed didn't do its job. They put the big old kibosh on the most overheated area of the stock market by raising interest rates a few percentage points. They crushed vast swaths of stocks, even in the increasingly rare cases where the underlying businesses were doing just fine. Fighting the Fed? Mugs game. John in Wisconsin. John.
Hey, Jimbo. Thanks for all your help and insight. I'm a real big fan. What are your
thank
thoughts
you.
on Shopify? And can they
I think
compete
Shopify is
with
going to
Amazon?
make it through this period. Shopify will make it through this period, and at 35 with a market cap of 38 billion, I'm actually willing to take a position and then bet it comes back to 33 and buy a little more. While we're at it, let's go on this special pre-Thanksgiving Day show to Willie in North Carolina. Willie.
Hi, Jim. How are you, sir?
I'm doing well. How about you?
I'm amazing, and I just want to let you know that Santa Claus is going to bring me a gift this year, and the gift is going to be I'm going to become a member of the club. So that's the only thing I asked for Christmas this year. I have one confession.
Absolutely.
The question is, I'm looking at Wayfair.
Willie, no. We don't want to look at Wayfair. It's too hard. We want bluer chips. We want better deals. We want more of a stock. Honestly, I'd rather see it by Williams-Sonoma. And by the way, this for Willie and everyone else, Black Friday, Cyber Monday, exclusive offer. Look at this. Join Jim Cramer, that's me, and the CNBC Investing Club for a discounted holiday price. And then it even has this kind of cool thing, like, right? And this is, oh, by the way, all you have to do is hold your phone up. You go like this. What do? It's like this way or that way. Is it this? I'll ask my kids, and then you can subscribe. Never let it be said that the Fed didn't do its job. On Mad Money tonight, HP reported earnings after the bell. So what did the company have to say about the state of the PC market with analysts fearing a slowdown? I'm breaking down the numbers and all about it. Then oil has a tough relationship with Thanksgiving. So what could this year's market bring? Maybe turmoil? And I'm going off the charts. And Wabash has soared more than 50% in the last month. So could this just be the beginning of a greater move? I'm getting the latest from the CEO. So stay with the Investing Club and use this thing. This thing gives you like everything. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.